You've seen the ads. They're everywhere. Invest in 24 karat gold for just 1 rupee, right from your phone. In a world that feels more uncertain by the day, it's a tempting promise. So maybe you did it. You tapped a few buttons on your payment app, bought some digital gold, and felt like you made a smart, modern, and safe investment. It feels easy. It feels secure. But what if I told you that you might not own any gold at all? What if that shiny number in your app is just a placeholder for a promise with no real oversight? Today, we're pulling back the curtain on the world of digital gold. We're going to expose the critical and often hidden difference between a genuine asset backed investment and a digital illusion that could vanish, leaving you with nothing. This isn't just about smart investing, it's about financial survival. Because in the world of money, what you don't know can hurt you. First things first, digital gold isn't one single thing. It's a marketing term, a catch all phrase that covers two totally different kinds of assets. And confusing them is the first mistake any investor can make. On one side, you have gold backed digital products. The idea here is simple. You're buying an electronic receipt for real physical gold. When you buy this kind of digital gold, whether it's on an app or through a regulated stock exchange, you're supposedly buying a claim on actual gold sitting in a secure vault somewhere. This includes everything from the digital gold on payment apps to highly regulated instruments like gold exchange traded funds, ETFs. The core promise is a direct link. 1 unit of your digital holding equals 1 unit of real physical gold. On the other side, you have cryptocurrencies that are simply marketed as digital gold, and Bitcoin is the most famous example. But this is just a story, a comparison, not a physical reality. There's no vault full of gold bars backing Bitcoin. Its value isn't tied to any physical thing. The digital gold nickname comes from qualities it shares with the metal. It's scarce, with a supply that's hard coded to a limit of 21 million coins. It's also portable and exists outside the control of any single government or bank. Supporters will tell you it does the same job as gold, acting as a store of value when governments are printing endless amounts of money. But here's the bottom line: one is a claim on a physical asset, and the other is a purely digital asset with no physical backing. They may use the same slogan, but their risks, their rewards, and how they work exist in completely different universes. To know if your investment is real, you first have to know which universe you're in. We'll start with the one that sounds safer, but is filled with hidden traps: the world of gold backed products. The sales pitch sounds so simple. You open an app, put in your money, and boom, you own gold. The company you bought from, let's call them the distributor, supposedly works with another company, a custodian, that stores the physical gold in a vault. It all sounds airtight, but there's a part they don't advertise, where this digital dream can become a financial nightmare. The single biggest danger here is the lack of regulation. In many places, the digital gold sold on popular apps is not considered a financial security. For example, the Securities and Exchange Board of India, SEBI, issued a direct warning to investors on November 8, 2025, clarifying that many digital gold products operate outside its rules. This means the standard protections you get in the stock market, things like guaranteed disclosures, official ways to resolve disputes, and oversight of the assets, might not exist at all. It's like a bank operating with no government insurance, no security guard, and no required audits. If that platform goes bankrupt or turns out to be a scam, your money is likely just gone. This regulatory vacuum leads to a few critical questions you have to ask to figure out if your gold is genuine. First, is your gold allocated or unallocated? This isn't just jargon. It's the difference between owning gold and owning a fancy IOU. Allocated gold means a specific identifiable piece of gold, like a bar with its own serial number, is registered in your name and held for you. It is legally your property. If the company storing it goes bust, their creditors can't touch it. It's yours. Unallocated gold is where the real danger is. You don't own a specific bar. You just have a general claim on a pool of gold that the company holds. You're basically an unsecured creditor. The company owes you gold, but it's mixed in with their own assets. They can even lend it out. If that company fails, you have to get in line with all its other creditors, and you could end up with nothing. Many cheap digital gold products are unallocated because it's cheaper for them, but it shifts all the risk onto you. Second question: where are the audits? A trustworthy company should have regular independent audits to prove that the physical gold in their vault matches all the digital gold they've sold. But you have to dig deeper. Who is the auditor? Is it a well known, reputable firm? How often are they checking? And most importantly, can you actually see the audit reports? If a company is vague about their audits, that's a huge red flag. They're asking for your blind trust. Third, can you actually get your gold? The ultimate test of ownership is being able to turn your digital holding into physical metal. A genuine product should let you take delivery of your gold as coins or bars. But check the fine print. What's the minimum amount for delivery? Sometimes it's so high that you'd need to own hundreds of grams. What are the fees for making and delivering it? These costs can be so high they make redemption totally impractical for a small investor. If you can't realistically get your hands on your gold, do you really own it? And finally, who is the custodian and where is the vault? The app you use is often just the seller. The real gold is held by someone else. You need to know who this custodian is. Are they a major bank or a specialized vault operator? Are they insured? And where is the vault? A vault in a stable country like Switzerland has a very different risk profile than one in a less stable region. Your gold is subject to the laws and risks of the country where it's stored. If you can't get clear, satisfying answers to these questions, you aren't investing. You're gambling on an unregulated company's honesty and competence. That's a risk that has nothing to do with the price of gold. Now let's talk about that other digital gold, Bitcoin. The story is powerful, and it's pulled in billions from investors of all sizes. The big claim is that Bitcoin is a better version of gold for our times. It's provably scarce thanks to its code. It's decentralized, so no single person or government can control it. And it's incredibly easy to move. You can send millions of dollars across the world in minutes. This idea has gained serious ground. The year 2025 saw a wave of institutional adoption, with major asset managers launching Bitcoin ETFs and some companies even adding it to their balance sheets. These moves make it feel like a legitimate store of value, and proponents will argue it's a system built on math, not on trusting people. You don't need an auditor. You can verify the supply and every transaction yourself on the public blockchain. But this is where the digital gold analogy starts to fall apart, and where investors need to understand the huge differences in risk. The most obvious one is volatility. Gold is known for being stable, a safe place to park money during a crisis. Bitcoin is famously wildly volatile. While it has delivered mind-blowing returns, it's also known for gut-wrenching price crashes. For instance, after hitting a record high of over $126,000 in October 2025, Bitcoin saw a sharp correction. Throughout 2025, while gold played its classic role as a steady safe haven, Bitcoin often behaved more like a high-risk tech stock, swinging up and down with market sentiment. An asset that can drop by 30 to 40% in a short time isn't a reliable store of value in the traditional sense. The second, bigger break in the analogy is that Bitcoin has no physical form. There is no redemption option for a bar of metal. Its value comes entirely from what people are willing to pay for it, a shared belief that it's valuable. That's not necessarily a flaw. The US dollar isn't backed by gold either, but it puts Bitcoin in a totally different risk category. Its value is based on code and consensus, which introduces risks that physical gold just doesn't have. What are those risks? For one, technology risk. The Bitcoin network has been amazingly secure for over a decade, but it's still software. The potential for bugs, the future threat of quantum computing, or a major disagreement that splits the network are all risks you have to consider. Then there's custodial risk. With Bitcoin, you are your own bank. That's empowering, but it also means you're 100% responsible for keeping it safe. If you lose your private keys, the password to your Bitcoin, your money is gone forever. There's no one to call. Finally, there's regulatory risk. Governments are still trying to figure out what to do with Bitcoin. The rules are always changing, with potential for new taxes, new tracking requirements, or even outright bans. This uncertainty creates a risk that gold, a globally accepted asset for thousands of years, just doesn't face in the same way. Labeling Bitcoin digital gold is a catchy but dangerous oversimplification. It's a revolutionary asset with a fascinating value proposition, but it is not a digital version of gold. It is a high risk, high reward bet on a new kind of monetary technology. So, after dodging unregulated apps and navigating the wild world of crypto, how do you invest in gold safely and genuinely? It's about moving from risky gambles to regulated, transparent investments. Let's break down the best tools for the job. If your main goal is maximum safety, direct ownership, and a hedge against a total system meltdown, then nothing beats owning physical gold. This means buying actual gold coins or bars and either storing them securely yourself or in a professional, insured, and allocated vault. This completely removes counterparty risk. The gold is your tangible property. The downsides: storage can be a hassle, and it's not as easy to buy or sell as clicking a button. If your goal is convenience and liquidity, but with real ownership and regulatory protection, then regulated gold products are your answer. This is where you can truly and safely invest in gold without holding the physical bars. The best options here are gold ETFs, electronic gold receipts, and sovereign gold bonds. First, gold exchange traded funds, ETFs. A gold ETF trades on a stock exchange, just like the share of a company. The fund's only job is to own huge bars of physical gold in a secure, audited vault. When you buy a share of a gold ETF, you're buying a piece of that underlying gold. These products are heavily regulated by bodies like SEBI. They are required to publish audits, and the custodians are typically major global banks. ETFs give you the convenience of digital gold, but with the transparency and legal protection you deserve. Next are electronic gold receipts, EGRs. Also traded on stock exchanges, EGRs represent physical gold stored in designated vaults. They are a regulated way to trade gold in a dematerialized form, bridging the gap between physical gold and financial markets. Finally, for investors in countries like India, there are sovereign gold bonds, SGBs. These are arguably one of the most compelling gold investments out there. They are certificates issued by the government itself, denominated in grams of gold. Because they are backed by the government, there is zero counterparty risk. Better yet, SGBs actually pay you interest, historically a fixed rate of 2.5% per year on your gold holding. It's an investment that tracks the price of gold while also giving you a yield. The only trade-off is that they are less liquid, with a fixed tenure of 8 years, though you can exit after 5. So here's the simple version. Unregulated digital gold apps sell you convenience but hide massive risks. Gold ETFs and EGRs give you that same convenience, but inside a regulated and transparent system. Sovereign gold bonds offer the ultimate in safety, backed by the government itself. So where does Bitcoin fit in? It should be seen as a completely separate asset class. If your goal is speculative exposure to a new technology with moonshot potential, then a small allocation to Bitcoin can be considered. Treat it like a venture capital investment, not like your stable gold holding. It's your high risk, high reward play, not your safe haven asset. The term digital gold is a marketing slogan that hides a messy and divided reality. On one side, you have unregulated apps that offer convenience but can be a trap. Their lack of oversight and the critical risk of unallocated holdings mean you might be buying nothing more than a risky promise. On the other, you have Bitcoin, a revolutionary but volatile asset that's a speculative bet, not a stable, safe haven. The genuine path to investing in gold today lies through regulated channels. Gold ETFs, electronic gold receipts, and sovereign gold bonds give you the security and legal protection every investor deserves. They let you own real gold without gambling on an unregulated app. Convenience should never cost you your security. Before you tap that buy button, ask the hard questions. Is it regulated? Is it audited? Is my ownership direct and protected? If the answer is no, you aren't investing, you are hoping. Your money deserves to be in a genuine investment, not a digital illusion. If this video helped you see the real risks behind digital gold, hit that like button. And more importantly, share it with someone who might be investing through one of these apps. Your share could save them from a huge mistake. For more deep dives that help you protect and grow your money, make sure you subscribe. Thanks for watching.